This is gonna blow your mind. While the world tries to punish Russia, India and China just can't resist snapping up its oil. Here's why. Since 2022, the West has been engaged in a complex economic maneuver aimed at punishing Russia without crippling the global energy supply. The primary tools have been sanctions and an audacious price cap, designed to limit the revenue flowing into Moscow's coffers. Initially set at $60 per barrel in early 2023, the G7 and EU have since tightened the screws. As of September 2025, any company using Western shipping, finance, or insurance services is forbidden from handling Russian crude sold above a newly lowered cap of $47.60 per barrel. This policy, while intended to be punitive, has had an unintended consequence. It has institutionalized a discount on Russian oil, creating a two-tier market where Russian barrels are perpetually on sale for those willing to buy them. To keep its oil flowing and its economy afloat, Russia has been forced to offer its crude at prices that are simply too good to refuse. For nations like India and China, this has presented an unprecedented economic opportunity. In September 2025, Russian Urals crude is trading at a tempting $2 to $3 discount to the global Brent benchmark. While this gap has narrowed from the dramatic 13.6% discount seen in 2023, it widened again to over 6% by mid-2025. For countries that import millions of barrels daily, even a small discount per barrel translates into billions of pounds in national savings, making the political complexities of the purchase a problem for another day. This is the simple, brutal logic of energy economics in a fractured world. Adding to Russia's ability to offer these discounts is its remarkably low cost of production. It is one of the world's most efficient oil producers, able to extract crude from its vast reserves cheaply. This structural advantage means that even when selling oil well below global market rates, and even below the Western price cap, Russian energy firms can remain profitable. This resilience is further bolstered by a devalued ruble, which reduces domestic operating costs when measured against dollar-denominated oil revenues. Consequently, Western sanctions, while impactful, have not delivered the knockout blow that was perhaps anticipated. Instead, they have inadvertently created a bargain bin for one of the world's most essential commodities. To circumvent the price cap and deliver its discounted product, Russia has cultivated a so-called shadow fleet. As of June 2025, this clandestine armada was responsible for shipping nearly 60% of Russia's seaborne crude. Furthermore, a recent spate of Ukrainian drone attacks and planned maintenance has knocked out up to 17% of Russia's domestic refining capacity. This has paradoxically pushed even more raw crude onto the export market, increasing supply and putting further downward pressure on the price for its key Asian customers. Exposing the hidden journey of Russian crude as it transforms into global fuel. For India, the allure of discounted Russian oil has been transformative. Before 2022, Russia was a negligible supplier, accounting for less than 2% of India's total oil imports. Today, the situation could not be more different. By July 2025, that figure had skyrocketed to 36%, making Russia India's single largest source of crude. This month, Indian refiners are planning to increase their purchases by another 10 to 20%, adding up to 300,000 barrels per day to their already substantial intake. The reason is purely economic. Between April 2022 and June 2025, India saved an estimated $17 billion by choosing Russian barrels over more expensive alternatives from the Middle East or Africa. These savings are not just an abstract number on a government ledger, they have a profound, real-world impact. For a developing nation of 1.4 billion people, cheaper energy helps to tame inflation, keeping the cost of transport and goods in check for ordinary citizens. It provides a crucial subsidy to an economy that grew by an impressive 7.8% in the first quarter of this fiscal year. The billions saved also help stabilize India's current account deficit and strengthen the rupee. From New Delhi's perspective, this is a matter of national interest and energy security. India has long pursued a foreign policy of strategic autonomy, and it sees the decision to buy Russian oil as a sovereign right, not an act of defiance. China, the world's largest oil importer, has followed a similar logic, but on an even grander scale. It is the #1 buyer of Russian seaborne crude, using the cheap energy to power its colossal industrial base and manage its own economic headwinds. Like India, Beijing has resisted Western pressure, viewing access to affordable and reliable energy as fundamental to its national security and economic stability. The strategic alignment between Moscow and Beijing, which has deepened in recent years, makes this energy relationship a natural fit. For China, the discounts are a welcome bonus that supports its economic objectives, while also strengthening its geopolitical partnership with Russia. This Asian pivot has fundamentally redrawn the global energy map. It has created a powerful new trading bloc that operates largely independently of Western financial and regulatory systems. While the United States has been publicly critical of India's role in this new dynamic, China has, interestingly, faced less overt scrutiny despite being the larger purchaser. This demonstrates the complex calculations at play in Washington. The reality is that both India and China have become indispensable outlets for Russian oil. Without their enormous appetite for discounted crude, Russia's exports would collapse, and the global market would face a supply shock of epic proportions. Exposing the hidden engine behind the world's cheap oil, this is why you need to understand how Russian crude is fueling the global economy, even as sanctions bite. The story does not end when Russian oil arrives in Indian ports. It is here that a crucial and controversial chapter begins. India's sophisticated private refineries, most notably Reliance Industries' colossal Jamnagar complex and Nayara Energy's Vadinar facility, have become central players in this global energy realignment. These facilities are masters of chemical engineering, capable of processing the cheap, heavy Urals crude from Russia and transforming it into high-value refined products like diesel, petrol, and jet fuel. This processed fuel is then sold on the global market, often to the very same Western nations that have sanctioned Russian crude in the first place. The scale of this operation is staggering. Reliance Industries, led by billionaire Mukesh Ambani, has dramatically increased its reliance on Russian feedstock. In 2025, an average of 50% of the crude processed at its Jamnagar refinery originated from Russia, a massive jump from just 3% in 2021. Between February 2023 and July 2025, Reliance exported an astonishing $36 billion worth of petroleum products to countries that have sanctioned Russia, including Media Group, oil tanker trucks leaving refinery, export shipping containers labeled petroleum at port at stock at distribute equally, $19.7 billion to the European Union and $6.3 billion to the United States. Nayara Energy, which is majority owned by Russian entities including Rosneft, sourced an even higher 66% of its crude from Russia in 2025. This practice has been dubbed the refinery loophole. Current Western sanctions target the origin of the crude oil, but not the origin of the refined products. As long as the oil is substantially transformed in a third country like India, it is no longer legally considered Russian. This allows Indian refiners to profit from the arbitrage, buying crude at a discount and selling the finished products at full market price. It is a lucrative business that has seen India's refined product exports soar, reaching a value of $97.47 billion in the 2022 to 2023 fiscal year. For the West, it is a frustrating reality, as it indirectly allows Russian oil in a different form to continue fueling their economies. However, the tide may be turning. The European Union, a major destination for these Indian exports, is poised to close this loophole. A ban on the import of refined petroleum products made from Russian crude is set to take effect in January 2026. This move will directly threaten the business model of Indian refiners and could significantly disrupt global fuel flows. Simultaneously, the Trump administration in the United States has taken a more aggressive stance, imposing a steep 25% tariff on a wide range of Indian goods in 2025, explicitly linking the move to India's continued energy trade with Russia. The golden age of the refinery loophole may be drawing to a close. Are you worried about skyrocketing gas prices and global economic shocks? You should be, because what's happening with Russian oil right now could change everything you thought you knew about the world's energy markets. The intricate dance between Russian supply, Asian demand, and Western sanctions has created a fragile equilibrium in the global oil market. However, this balance is now facing its greatest test. The recent punitive measures from both the United States and the European Union are designed to force India's hand. The 25% U.S. tariff on $86 billion of Indian imports represents a significant economic blow, potentially shaving up to a full percentage point off India's GDP growth. The impending EU ban on refined products threatens a core revenue stream for India's powerful corporate sector. The West is betting that this economic pain will be enough to compel New Delhi to abandon its cheap Russian oil. So far, India has shown no signs of backing down. In a clear signal of defiance, Indian refiners are actually increasing their Russian crude orders for September 2025. This decision underscores a fundamental belief in New Delhi that its energy security and economic needs supersede Western geopolitical objectives. But then, in August 2025, a major turning point arrives. Donald Trump, having returned to the White House, imposes sweeping new tariffs not just on India, but also on China and several other countries. These tariffs send shockwaves through the global economy, instantly raising the cost of trade and putting even more pressure on Asian economies that rely on affordable energy. For India and China, the move is a wake-up call. Both countries double down on their strategy of securing cheap Russian oil, seeing it as a vital buffer against Western economic coercion. The tariffs also force India and China to accelerate efforts to build alternative payment systems and deepen energy cooperation with Russia, further fragmenting the global oil market. Meanwhile, the rest of the world braces for impact. Basic economics dictates what would happen next. A sudden supply crunch would cause prices to spike dramatically. Market analysts warn that in this new era of tariffs and fractured alliances, global oil prices could surge towards $100 per barrel. For consumers in the UK, Europe, and the United States, this would mean a sharp increase in the cost of filling up their cars and heating their homes, fueling inflation and potentially triggering an economic slowdown. It is the great paradox of the sanctions regime. Trying to punish Russia too severely could inflict just as much pain, if not more, on Western economies. The Trump tariffs have now made the global chess match over cheap Russian oil even more complex, with every move carrying higher stakes for everyone, not just traders and politicians. It directly influences the price of energy, which in turn affects the cost of almost everything we buy. The decisions made in New Delhi, Beijing, Moscow, and now Washington have a direct impact on household budgets in London and New York. The current situation reveals a world increasingly divided into competing economic and strategic blocs. How this story unfolds will not only determine the future of global energy markets, but will also shape the geopolitical landscape for years to come. The stakes could not be higher.